Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, we made it to the end of the week. What's going on in the stock market today? Well, stock market's up. Dow's up about 250. Nasdaq's up about 120. We're having a big update today, right? Well, what happened this week? Now, a lot of things went on this week. I mean, there's a lot of stuff going on right now. Big news is the debt got downgraded. Fitch rating agency came and downgraded us from AAA down to AA plus. Now, a lot of people are upset with Fitch for downgrading our debt. They're thinking that this should never happen. Biden administration's very upset. Some people in the business community say it's unwarranted. I think that AA plus is a very high rating for our debt. Look, we're going to hit 35 trillion in debt this year, and there is no way in the world that that's ever going to be repaid back. Now, are we going to keep paying the interest on? Are we going to keep making the interest payments? For a while, as long as the interest rates don't go up too high, we'll keep making those interest payments. Now, I think that this is all going to bring the stock market come crashing down. I think the stock market's going to come down a lot from here. We may get a little push up here. Nothing goes straight down. We're having a push up today. Today, they're buying the debt. You see, someone's in there buying all of this debt today. Now, I would probably guess that that's the Federal Reserve. You see, I think the Federal Reserve is losing control. They're losing control of the market, not the stock market. They're losing control of the debt market. Now, what's going on really in the debt market? Well, let's talk about this for a moment. All right, so we got this inverted yield curve, right? The yield curve's inverted. What does that mean exactly? Well, it just means that the 2-year is paying more than the 10-year. 2-year, these are rough numbers, that's called 5%. The 10 years only paying 4%. So it's this inverted yield curve. And everybody knows that that's going to bring a recession, right? That's never failed. It brings a recession when you have the inverted yield curve. Now, what's happening right now is the long end is starting to go up. It's starting to go up. The TLT is going down. That's the bond, the ETF, and that's dropping like a rock. Now, today they're in there buying. It's having a big up move today, but it's coming down. They're losing control of the long end. Now, when the yield curve re-inverts back, gets uninverted, if you will, that's where the problems happen. So you got the 2-year at 5%, the 10-year at 4%. Now, when the 10-year goes back above the 2-year, up above 5, maybe to 6%, that's where the bad stuff really starts happening, okay? That's where you get a lot of bad stuff happening, and there's so much happening all together right now. I mean, we're still getting bank runs. The banks are still in a lot of trouble because they're raising interest rates into the system where the banks already have big problems, right? They're hiking the interest rates, and that's a big problem for the banks. And we're getting a lot more layoffs coming on. Yellow trucking industry, that was 30,000 layoffs. So, I mean, where I live in Silicon Valley, the tech businesses all laying people off. I mean, it's interesting. Actually, I was talking with a gentleman yesterday. He got transferred from Qualcomm. Qualcomm transferred him from Texas to the Silicon Valley area. So he got transferred from Texas. He's still trying to sell his house in Texas. He's been there about a year, but he's bought a house here. But Qualcomm just announced mass layoffs happening in October. He doesn't know if he's going to have a job. He's trying to still sell his house in Texas, and now he might have to sell his house here. He might have 2 houses to dump. Anyways, he's under a lot of financial stress, not knowing if he's going to lose his job or not. But there's a lot of people, when they lose their job, they don't know how they're going to make their house payments, right? So there's going to be a lot of layoffs, and that's going to result in a lot of people not being able to pay their mortgages. So you get the layoffs coming, and the layoffs are caused by these raise in interest rates. Now, when they raise the interest rates, what happens? Well, what you have is a lot of zombie companies in the S&P. About 20% of the 500 companies that make up the S&P 500 are zombie companies, and some of these are starting to go out of business. But a lot of them are just not able to make their payments, so they have to borrow more money at this higher rate, and they have to do something. They have to lay people off. So the layoffs are starting to come right now. They're starting to come out, and mass layoffs are happening, and what this does is make people not be able able to pay their mortgage. But you see, it's kind of got a delayed effect. You see, they raise the rates. That's causing businesses to have some problems getting capital. So they start the layoffs. Once people are laid off, they try to hold on to their house as long as they can. So there's a lag effect about 6 to 9 months out, right? So this lag effect is now coming into play. A lot of people got laid off earlier, and now they're having trouble making their mortgage payments. But all of this takes time to play out. But there's so much happening all together right now. It's happening all at the same time because of these rate hikes. The rate hikes are going up higher. Now, once the yield curve uninverts and that long end gets up higher, what's going to happen to mortgage rates? Well, it's going to jump them up a bit. Now, we're well above 7% right now for the 30-year fixed rate, and that's going to jump up above 8%, maybe even above 9%. Now, a lot of battle cry has been from the real estate community to buy now and refinance later. Well, look, you're buying right now, your equity is actually dropping, so you're not going to be able to refi. But even if you could refi, you're going to be refining at higher rates. I personally believe that mortgage rates will hit double digits again. I think you're going to see 10% mortgage rates. Now, everybody tells me, Mike, you're crazy. Mortgage rates are going to come down to 5%. Everybody knows that. I don't think so. I think if you buy a house right now at these rates, you're not going to be able to refi at a lower rate. You're going to have higher rates coming. Once again, that's just my opinion, just my take. Of course, everybody disagrees with me, but you got a lot of stuff going on right now. It's all caused by the rise in interest rates. When the Fed keeps raising the rates, it causes a lot of problems. Now, a lot of problems come in the refinancing of mortgages, refinancing of loans. Let's take apartment buildings, for example. Okay, so multifamily units. Now, a lot of people listening don't go buy multifamily units. Well, people that own apartments are having trouble selling them because rates went from 0% to 5.5% right now, and that means the value of their property goes down. They can't sell it for as much. It's called the cap rate. So anyways, they have to sell the property for less. Their property becomes less. But there's another problem in the multifamilies right now. Rents are starting to come down. So rents are coming down, and they can no longer sell the building for what it was worth. So when they go to refinance, they can't get any money out because they can't get a loan. So they can't refinance and they can't sell unless they drop the price of the property. And now what's happening with these ETFs, people like Blackstone, these are syndicates, right? And these people want their money back out of these ETFs, but they can't get their money out because Blackstone cannot sell these apartment buildings that they own for a price anywhere close to what they paid. So they would have to sell them at a big loss just to give people their money back. So what Blackstone has done is say, no, you can't have your money. We're not accepting redemptions. So people cannot get their money out of the funds that they invested in because they took that money, they bought these apartment buildings, and now the people can't get their money out. Blackstone has just said we're not allowing any redemptions at this time. And this has been going on for almost a year now. A lot of people very upset. And these are a lot of wealthy people that have invested in these funds. So even the wealthy people are getting hurt that they can't get their money out. Now, once again, you got a big problem in the refinancing of commercial buildings. These would be the big office towers in cities like San Francisco, New York. A lot of these have come way down in price. Why? Well, because they're not getting the rent money because they're sitting vacant. Some of them are sitting as much as 50 or 70% vacant right now. Everybody went to the work for home. Everybody moved out of the office buildings. So these office buildings are now worth a lot less money. And they don't have 30-year loans on these. So when they go to refinance these, they can't get a loan. You see, look, let's say they paid $40 million for the building, right? So they bought this big office tower for $40 million. All right. But they got a loan for $28 million. Okay, that makes sense, right? They got some equity built in there. But now this $40 million office building is only worth $20 million. Oh, that's a little problem because they owe 28 million. So they got to go refinance because their refinancing comes due every 3 years. So they go to the bank and they say, I'd like to refinance this. And the bank says, that's great. Why don't you bring us $10 million, $10 million more on top of what you owe on the building so that we can refinance. Well, I don't have $10 million. I bought it for 40 million and it's got to be worth, well, it's worth about 20 million. You owe 28 million. We can't give you 28 million. So they can't refinance. So what happens? So they hand the keys back to the bank and now the bank owns the big towers, the big office buildings. You see, there's so many things going on. The apartment buildings going down, the office buildings going down. And yes, your houses are soon going to be going down. Everybody gets upset with me because they think I'm calling for a crash. Look, I'm not calling for a crash. I'm saying they're going to drop by 40 or 50%. If they crash, yes, they could crash. That'd be more like 80 or 90%. But yes, I think we're going to correct back to what's normal, back to the mean, back to the long-term moving average, which is down about 40 or 50% from here. And the reason they're going to correct is because mortgage rates are going to continue to go up. You're going to see 8% mortgage rates, and that's for 800 credit score. You don't have an 800 credit score, you're going to be looking at close to a 9% mortgage rate. And I think that will happen by the end of this year. And going into next year, yes, I think we're going to see double-digit mortgage rates. Look, there's a credit crisis right now, and people don't get this. The banks are having runs right now, right? There's a credit crunch. People, when banks are getting all the money sucked out that people left there for deposit, they don't have the money to lend out. They don't have money to lend out for the apartment buildings, for the office buildings, for the residential real estate, because every loan that they made has now dropped in value. They could sell those loans into the marketplace, but then they'd have to take a hit. They'd have to mark them down. It's called mark to market. And they would have to mark them down to the market rate. And they don't want to do that because that makes their profits go down, which makes their corporate bonuses go down to the big wigs. Look, banks are in trouble right now. They're in a lot of trouble. The Federal Reserve, I'm telling you, they're probably petrified right now. They can see what's going on. They don't talk that way to you, but behind closed doors, they know there's a big problem. They know that the banking system is about to all come down. I mean, this could lock up. This could freeze up. The system is under a lot of stress right now. And if the system comes down, the price of your house is one of the last things you're going to have to worry about. The system is under a lot of stress right now. Now, I pray it doesn't come down, but eventually it's going to, because we're built on a Ponzi scheme. We're built on just more and more and more debt. But right now, the banking system can't create more debt because they don't have enough deposits. The banks are paying you 5.25%, trying to get more money in so they can start making loans again. Right now, they can't make the loans because they don't have the money to make the loans with. This is called a credit crunch. And what it's doing, it's actually drying up the M2 money supply. The money supply is going down. Yes, we're printing money like crazy, but the M2 money supply is going down because because banks are not making loans and they are having to call in the ones they got because there's no equity in those big, tall skyscrapers anymore. There's no equity in those apartment buildings anymore. They can't refinance them anymore, so the debt is actually getting sucked out of the system in that format, reducing the M2 money supply. This is a big problem. Now, nobody's talking about this on mainstream. You can go listen to mainstream. Hey, the best economy ever. Everyone's got a job. We got 10 million jobs waiting for people out there. And that's really good because there's going to be 10 million people that are losing their jobs right now. And I'm starting to know a lot of them personally because I live in the Silicon Valley area and in the tech industry, layoff after layoff after layoff. And it's getting a little frightening for these people. They don't know where they're going to get a job. They're out there networking again. But there's layoffs at Meta. There's layoffs at Google. There's layoffs in Qualcomm mass layoffs right there. Apple just came out with numbers. Oh, the iPhone, there's not a lot of demand for it. Maybe Apple's going to have some layoffs. Apple uses a lot of contract labor though, and they'll let those people go first so they don't have to say they're laying people off. But those people that are contract labor, those people are going to be out of a job and they're going to be looking for jobs also. This is a problem right now. A lot of people don't want to talk about this, and I know on Friday I always get a little carried away and I start talking about some of this bad stuff that's going on. But look, if I were in the market to buy a house, I would sit back and wait. Yes, mortgage rates are going to be higher, but the price is going to be so much lower, right? And you always want to buy lower on the price, and the interest rate, you can pay it off. You can refinance it. There's a lot of things you can do with the loans. Yes, I believe that the mortgage rate's going up, and if you go talk to your local realtor, they go, you got to buy now. You can get a 7.5% mortgage right now. It's going up to 10. It's not, do not buy right now. Yes, it's going up to 10, but the prices are going to be coming down. There's going to be a lot of you that are sitting out there, I'm locked in at 2.8. Mortgages are going to be at 10. I'm going to be sitting in the catbird seat. Your values are going to go away. Your equity is going to get wiped out. I'm not calling for a crash. I'm calling for a 40 to 50% correction back to the mean. A crash would be 80 or 90%. I don't believe that's going to happen. Could happen? Yeah, it could happen. Could happen. The Mike's just talking crazy stuff on a Friday. Anyways, if you like this stuff, give me the thumbs up. Why not? It's Friday. Get out there, everybody. Have a great weekend. Hit the subscribe button. I want to talk to you again real soon. Bye-bye now.